Hello, good morning everyone. We are from Group 6 and today we will be presenting our financial risk management assignment. For our case study, we focus on two companies under the Genting Group, which is the first one is Genting Malaysia Berhad and the second one is Genting Hong Kong Limited. To begin, let me introduce Genting Malaysia Berhad first. It is one of the Malaysia's largest leisure and hospitality groups best known for Resort World Genting, the country's only legal lane-based casino. Their business model is built on the integrated resort concept, combining hotels, casinos, theme parks, shopping, food and beverages, and also entertainment all in one destination. The company also has operations overseas in the US, UK, Bahamas, and Egypt. Let's look at Genting Hong Kong Limited. It was a Hong Kong-based cruise and leisure company under the Genting Group. The company operated several cruise brands such as Dream Cruise, Star Cruise, and Crystal Cruise. Its business model focused mainly on international cruise tourism, with revenue coming from ticket sales, onboard entertainment, gaming, food and beverage, and also luxury hospitality package. Genting Hong Kong also invested heavily in shipbuilding through MV Werften and Lloyd Werft shipyards in Germany. For the next part is why these two companies were chosen. We selected Genting Malaysia and Genting Hong Kong because of both companies face the same external shock in the tourism industry, but the outcomes were very different. Genting Malaysia survived and recovered, while Genting Hong Kong collapsed and went into liquidation in 2022. This made them a strong case study in financial risk management. In comparison, Genting Malaysia survived because of diversified revenue streams, strong liquidity, and proactive management decisions. Genting Hong Kong failed due to over-reliance on cruise tourism and heavy debt financing. In conclusion, the key lesson here is that diversification and prudent debt management are critical in a high-risk industry. For future improvements, companies should strengthen debt and capital structures, improve liquidity planning, and diversify source of revenue. Overall, Genting Malaysia shows reliance while Genting Hong Kong highlight the danger of over-leverage and dependence on a single industry.
Imagine that investing more than 10 billion to transform a mountain resort into a world-class tourism destination, then suddenly your biggest project faces a legal dispute. How would you do? Today we will look at how Genting Malaysia managed these challenges and continue moving forward. Our story begins in 2013 when Genting Malaysia launched the Genting Integrated Tourism Plan. The company initially invested 5 billion to upgrade Resort World Genting with new hotels, attractions, and the main project, which is the theme park development. 3 years later, the management showed even greater confidence by increasing the investment to 10.38 billion. However, every success story faced obstacles. In 2018, Fox unexpectedly terminated its agreement for the 20th Century Fox World Theme Park. Instead accepting this situation, Genting Malaysia management took legal action to protect the company interests. 1 year later, in 2019, both parties reached a settlement allowing the project to move forward and ending this dispute. The tourism industry later faced significant challenges such as the COVID pandemic, causing the temporary disruption to the operation. Genting took action to control these challenges. More importantly, the company continued focusing on the long-term growth. New attractions such as the Genting Sky World Theme Park finally launched in 2022. By 2024, the company had achieved a stronger performance, showing that its long-term strategy was beginning to deliver the result. If we summarize Genting Malaysia journey in 3 words, they will be build better and bounce back.
Genting Malaysia is highly exposed to tourism demand risk because its revenue depends on visitor arrivals and spending in gaming hotels and entertainment. When tourism declines, its revenue, occupancy rates, and profitability are affected. The company also faced liquidity risks due to high fixed costs and major investment under the Genting Integrated Tourism Plan. Even when visitor number falls, expenses such as salary and maintenance still continue. It also exposed to credit and interest rate risk due to heavy borrowing. When rising interest rate increase financing costs. From a macroeconomic view, inflation, economic slowdown, and interest rate change in reduced spending and raise costs. However, Genting Malaysia maintains resilience through a strong cash position and diversified revenue stream. Overall, it operates in a high-risk but relatively stable position. Today, I'm going to talk about the economic consequences of the crisis on Genting Malaysia Berhad. To start with financial market, the pandemic hit the tourism and gaming sector hard. Travel restriction and casino closures reduced revenue and share price, and investor confidence weakness. However, Genting Malaysia remained relatively resilient due to its strong cash position and diversified businesses, which helped it recover as tourism reopened. For shareholders, there were short-term losses during the lockdown period, but the impact was more manageable compared to other tourism companies. As operations resumed, shareholder value gradually established. For stakeholders, employees faced reduced working hours, while customers and suppliers were affected by temporary closures and lower demand. Still, the company's financial strength helped reduce the overall impact. Government regulation also played an important role. Movement control and travel restriction reduced businesses' activity and increased operating costs, but later reopening policies supported recovery. Finally, at the industry level, tourism was heavily affected, with a sharp drop in arrivals and revenue. Even so, Genting Malaysia performed better than many peers due to its diversification and liquidity. So, overall, the key lesson is that strong financial management and diversification help companies stay resilient and recover faster during a crisis.
Now, I will explain how Genting Malaysia successfully survived one of its most challenging periods and what role risk management played in its recovery. But before that, I do think I'm blending into the background, so let's have a change. Okay, I'm not blending in anymore, and now you can focus on me and what I'm about to say. So to start off with, Genting Malaysia operates in a very highly competitive industry that constantly needs tourism and hospitality. So during a period of significant business disruption, what happened was the company experienced a very sharp decline in their visitor arrivals and also their business activities. So despite all this that happened, they actually was able to remain operational because it had a very strong financial risk management practices. So one of the key reasons was its diversified business model. So Genting, instead of relying on like a single source of income, Genting Malaysia actually generated revenue from different type of businesses, such as they have their gaming and entertainment operations like their casino, and then they have their hotels like their First World Hotel, and then they have food and beverage outlets, their retail businesses such as they have like their own complex for shopping like their Genting Premium Outlet, and other entertainment activities. So this diversification reduced the company's exposure to risk affecting any one business segment, and also help maintain overall financial stability. So another important factor was liquidity management. So management focused on preserving cash and ensuring that the company has sufficient financial resources to meet its operational commitments. So even when the revenue of Genting Malaysia declined significantly, Genting Malaysia still was able to maintain a strong liquidity position, allowing it to continue operations without experiencing any financial distress. In conclusion, Genting Malaysia survived because it effectively managed its risk through its strong liquidity management, diversified revenue sources, proactive management decisions, and a clear recovery strategy.
Now, let's look at the operational timeline of Genting Hong Kong. In 2015, Genting Hong Kong expanded its cruise business by acquiring Cruises and launching Dream Cruises, targeting the premium Asian cruise market. This strengthened its market positions and support business growth. Between 2016 and 2019, the company continued its expansions by investing heavily in the German shipyard and Wilmington to build new cruise ships. Although this increased its operations capacities, it also requires significant capital investment and placed greater financial pressure on the company. In 2020, the COVID-19 pandemic disrupted the global cruise industry. Genting Hong Kong suspended payments to creditors and preserved liquidity as cruise operations came to a halt. The company reported $3.37 billion in debt, a net loss of $742.6 million, and its share price fell more than 40%. During this period, the company also made leadership changes and sold assets in an attempt to improve its financial positions. Finally, in 2022, the situation became worse when the MV Wolfden filed for insolvency after failing to secure financial support. Soon after, Genting Hong Kong filed for liquidations in Bermuda, marking the collapse of the company after years of aggressive expansions and financial difficulties.
So before I start, let me ask a question. So how can a company with over $1 billion in revenues end up being liquidated? So the answer is not COVID-19. The answer lies in three major risks faced by Genting Hong Kong. So let's think what exactly are. So is it strategy? Is it level of reputations? So let's figure this out. So first, Genting Hong Kong relies heavily on debt financings, accumulating about $3.4 billion in debt to fund its crew, fleet, and shipbuilding projects. So it's really bad, right? So at first, this looked like a very good growth strategy which can earn a lot of money, but the more debt you have, the less room you have for mistake. So second, the company depends too much on single industry, which is focused on the cruise business only. So compared to Genting Malaysia, it have a very industry. So this means that when tourist demands weakness, the company has very limited alternative. So it's like putting all your eggs into one basket. When the basket falls, everything falls together. So it's very gross decisions on its business. So third, management continues aggressive expansion without maintaining sufficient liquidation reserve on financing flexibility. So in simple terms, the company focuses on growing bigger, not on going stronger. So as a result, revenue drops sharply while debts obligation remain high. So imagine losing 3/4 of your incomes, but your debt still need to pay, and your employees still need salary, and your operations still need fundings. So that was exactly the situation Genting Hong Kong faced. So the key lesson here is that Genting Hong Kong did not fall because of one crisis. It falls because high debts, poor diversifications, and weak risk management were already built into the business model.
The core vulnerabilities of Genting Hong Kong fail is because the revenue and liquidity crisis. When we compare both companies, the primary reason behind Genting Hong Kong's failures lies in its extreme revenue concentration and subsequent liquidity crisis. While Genting Malaysia successfully maintained a diversified portfolio across gaming, hotel, and theme park to buffer the income shocks, Genting Hong Kong relied almost entirely on cruise operations and international tourism. When the pandemic hit and travel restrictions were imposed, their core revenue streams evaporated overnight. Unlike Genting Malaysia, which had strong cash reserves to cover operating expenses, Genting Hong Kong faced immediate severe liquidity pressure. Their fixed costs and debt obligations remained dangerously in high while their income plummeted to near zero, rapidly pushing the company into deep financial distress. Second, the downward spiral of leverage decisions and risk governance.
Beyond the external shock, the failure was accelerated by aggressive financial leverage and reactive management decisions. Genting Hong Kong heavily relied on debt expansion to fund its ambitious cruise fleet and shipbuilding subsidiary, MV Werften. When crisis struck, their short-term decisions such as leadership restructuring and suspending creditor payments were simply insufficient to overcome this massive debt pool. In contrast, Genting Malaysia managed its large-scale GITP investment while strictly maintaining financial stability and funding capacity. Ultimately, while Genting Malaysia survived through proactive cost control and strong risk mitigation, Genting Hong Kong's reactive risk management failed to prevent a catastrophic cross default, proving that high leverage without a proper liquidity cushion is fatal corporate strategy.